Ladies and gentlemen, Tesla stock was up about 2% today. And here in this video, you may not like what I'm going to say, but Tesla stock is probably going to new all-time highs by the end of this year, by the start of 2025. But here's the part you might not like. It does set us up for a pretty violent correction. Now, this comes down to the data that came out today with the jobs report. And I will explain why I think we're going to see a year-end rally for Tesla and the broader markets. And then a pretty violent correction, probably in January of 2025. Okay, so the work is cut out for us here in this video. Hit the like button, subscribe to the channel if you guys would like to. But what's more pressing than that is what the jobs report today just said. Okay, so the unemployment rate is now almost at the highest level of this cycle. So remember in July, August, and September, when the S&P fell about 10% and there was this fear of a recession. Some people call it a growth scare. Okay, remember that? Seems like it was, forever ago. Well, we're back to the same data, same level of data that we were at then, now. The only difference I would say is people are a lot more bullish now than they were then for 2025, which kind of sets us up for this year-end rally and likely beginning of 2025 correction. See, what today really did for markets was it de-risks the end of this year. We have the jobs report out the way now. The last big catalyst is the Fed. And it's pretty forecastable what the Fed is going to do. They communicate a lot to us between meetings and kind of let us know what they're going to do. According to the markets, the Fed is certainly going to cut rates December 18th. And it would take something dramatic happening for the Fed not to cut rates. Okay, so the Fed's going to be cutting. We know that. And I think the markets are obviously going to like that. We always like when we get Fed rate cuts. But that's what today did. It took a fear catalyst off the table. And you can see with the VIX today, the VIX was down over 4.5%. People are just no longer fearful following this jobs report. Now, the jobs report today was really not good, especially if you look at the household survey and if you look at the unemployment rate. So specifically what I'm referencing is the unemployment rate. The unemployment rate is now at just see what Nick Timmerhouse says over here. House writes on X, the unemployment rate, arguably the best summary statistic in the monthly jobs report, ticked up to 4.2% in November. Unrounded, it was 4.246%, leaving it very close to the recent high of 4.253% recorded in July. So you were, 0.04% away from having a 4.3% unemployment number, of course, accounting for rounding. So we're basically back to the same unemployment rate we were in July. Basically, like less than 1/10 away from that. Or one-tenth away from that. Now, he goes on to say, job growth in the establishment survey has been fine, but the household survey showed the share of Americans, including the 25 to 54-year-old cohort who were working in November, was down from a year ago. The number of unemployed at 7.145 million was also close to the July high of 7.163 million. So you're not in a good place as far as the unemployment picture. We recently fell with the unemployment rate, and now you're back up again. And it looks like we're really starting to trend upwards again. Now, this is a problem. Why is this a problem? Well, some of you may be confused. Let me explain this. If you're investing in markets, this is a problem because expectations are the economy is going to be great next year. That's why the S&P is trading at the highest valuations you have seen since the dot-com bubble. Okay. We have expectations that next year, like a recession's not even in the cards. It's not even a possibility. That's what the markets are saying right now. And this data says otherwise. This data says the labor market is weakening at now a pretty aggressive pace. That was a big jump in your month-over-month unemployment rate. Okay. That's the problem for stocks. It's always about expectations. And I've said this on the channel before, but I'll say it again. What moves stocks in the near term is expectations. What moves stocks over the long term is earnings. Okay. So earnings do well, long term stocks do well. But what moves stocks in the near term is expectations. So when expectations are super negative, it doesn't take a whole lot of good news to cause, markets to go higher. Okay. When expectations are really good, it typically doesn't take a lot to cause stocks to fall. And that's kind of where we are now. Expectations are really high. And I don't think this is necessarily a problem for December because we're not going to get too much else as far as, big economic data. Nothing as big as the jobs report. The issue is when we start 2025, when we get that jobs report in early January, if that thing looks worse than the one that we just got, all of a sudden Wall Street's gonna have to face the facts that we may get a recession in 2025. And that is not on anyone's bingo cards right now. Okay, it's just not. And that is why I'm expecting a pretty aggressive correction in Q1 of 2025. It could happen in January. Now, you also have the psychological aspect of, Trump's the president now. Tariff policies could be enacted, but people aren't really freaking out about that now because nothing can actually happen until late January at the very earliest. Okay, so as we get into 2025, the tariff situation might start to feel real also. But I'm basing this expectation of a correction on the economy. Think about it like this. If we're expecting the economy is going to be really, really good next year, 3% GDP, stable unemployment, no recession, and then you have to start questioning that because the data is starting to come in bad, which is what happened today, then that changes the calculus for markets. And I think that's what is going to happen in Q1 2025. Now, why I think we're actually going to have a year-end rally, why I think Tesla is probably going to new all-time highs before 2025, before we have that, pretty aggressive correction, is because the Fed's going to be cutting rates December 18th. Almost a certainty, like a 90% chance of that. And we just de-risked for December with the jobs report now out the way. I think it's one of those scenarios as well that, Wall Street, they're going to wait till 2025 to start pricing in what could go wrong in 2025. Right now, I think it's more or less a chase. I think Wall Street's trying to chase the markets, trying to get allocated to the markets so they don't miss out on what could be another, good couple of weeks or a good year next year. Again, judging off of the consensus on Wall Street today. And that's the big reason I think December is probably going to be good. You also have seasonals, Santa Claus rally. Even someone like Tom Lee and JP Morgan are expecting the S&P could hit 630 by the end of December, which would be another 4.5% give or take from here. Now, when we get this aggressive correction, I think there will be an opportunity to hedge because I think this is going to be 10 to 15% correction. Could be closer to 20% if next month's jobs report is really bad. So I think there will be an opportunity to hedge, but I don't think you want to go crazy with hedges right now because I think December will likely be a good month for stocks. I don't think you want to get ahead of that. Now, as you've seen today, though, volume was very low on the S&P. And right now, it seems like you're just in a low liquidity melt up. And until something changes that, you're probably going to just continue to trend higher. Markets tend to follow the path of least resistance. And the path of least resistance looks like it is higher, at least for now. And again, Tesla hit a new multi-year high today at $377.52 per share. And the reason why I think Tesla likely will be at all-time highs by the end of December is, one, all of these factors that I have mentioned, this year-end chase, the Santa Claus rally that's likely to start, boosting up markets. But also, if you're looking at 2025, and if you're a fund manager and you're under the assumption that the economy is going to be strong, there's not going to be a growth scare, like things are just fine, what's going to outperform next year? I think Tesla's in the top quartile of the stocks that you would be looking at right now, right? Tesla, there's a lot going right for Tesla. There's not a very strong bear thesis on Tesla at all, unless you forecast a recession, which Wall Street does not. So from that standpoint, I think a lot of fund managers are going to be looking at Tesla and saying, what's the risk? Recession. What's the odds of that? Pretty low, according to the markets. What's the odds that Tesla over exceeds expectations with the new vehicle that comes out, with the robotaxi network that comes out, Tesla's, evolution in AI? The risk of Tesla over impressing is a lot higher than under impressing for next year. And I think that's why Tesla, again, is in the top quartile of stocks that could, perform exceptionally well next year. And I think that's why you're likely going to see a chase into Tesla into year end. And I think Tesla could be a $420 stock easily by the end of December, which from here to hit $400 would be about a 6% move higher. To hit 420 would be about 11.3% move higher. That is not that crazy to me. Call me crazy if you want, but I don't think that's too outlandish. But again, once you head into 2025, I think you're going to get a pretty severe correction. Now, I don't think the correction is going to be as severe for Tesla, again, because of what I just mentioned. Tesla is going to outperform, right? Most likely, it's going to have positive upside surprises versus negative downside surprises. There's a lot going right for Tesla from that standpoint. But I think you get a pretty aggressive correction in the S&P. And Tesla will also fall as well. But I think a lot of that correction is going to be in the S&P. But I don't think it's going to start here in December. I really think it's going to be a Q1 2025 kind of thing. And the reason I don't like the idea of being short right now is because what if the S&P does rally to 620 or 630 like Tom Lee and JP Morgan is expecting it, by the end of December? Then a 10% correction from, let's say, 630 only puts you down to about 567 or so, right? If you're buying like puts or something right now and markets go higher before that correction, you're probably going to lose money on that position. Now, a small hedge right now wouldn't be a terrible idea. Like, it wouldn't be the worst idea, but I don't think it's needed yet. Okay, if people are not freaking out today over the jobs report, I don't think they're going to wake up Monday morning and freak out over the jobs report, even though I think it's worth, second guessing the soft landing narrative. I've been under the assumption that we will not know if we're going to have a soft landing or not, at least until probably April, May of next year. Once we get a couple more jobs reports in, once we kind of see how the economy is after the holiday season, that's when we'll have a better understanding of, are we going into a recession or not? Wall Street has jumped way ahead of that and has already come to that conclusion. And judging off the unemployment rate today, the household survey for jobs, you lost 268,000 part-time jobs last month. You lost 111,000 full-time jobs last month, according to the household survey. Those are pretty damn bad numbers for a 1 month period. And I think we're just mismatched, right? If the odds of a recession next year are, let's say 30%, and Wall Street is at 0%, if we have to price in a 30% chance of a recession with a 22 times earnings multiple for next year, that is a big problem. That is a colossal problem. And I think that's to some degree what we could be faced with another bad jobs report. Just one more bad jobs report with the unemployment rate breaking out to a new higher this cycle. That would be a major issue for markets. So I don't know. This is just kind of my thoughts. Not super concerned for December, but very concerned about January and February-ish. Once you get that January jobs report, which will be January and February, that's where I think you'll get a real test of the bull thesis. Now, will the bull thesis be proven right? Probably. Like, is next year going to be a good year? Probably. But I think our expectations are too high for next year. And this can be scary to you, or this can be an opportunity for you. Depends how you look at it, okay? I think of it as an opportunity. If we do get a better buying opportunity on Tesla or on, other stocks in the markets, right? The best thing you can do now is prepare for this, is to raise cash where you can, to do extra, side jobs, do whatever you can to get as much money as possible. And that's the point of making this video. It's not to freak you out and for you to sell early and miss the next, 4% upside that could come in December, right? Historically, December is a good month during election years, and especially when the markets are already up 20%, you tend to go up another like 3% or so. Like historically, the data suggests December is going to be a good month. But I think expectations are too high for 2025. And there should be a greater chance of a recession baked into stocks. And that hasn't happened. And I don't think it's going to happen in December, but I think it most definitely will start in January. So hopefully this provided you a little bit of context. Maybe it didn't. Maybe you already knew this. Maybe you've kind of been suspecting this. I will tell you, with the UVXY, the volatility curve, people are positioning for volatility in Q1 2025. Like, people are paying more for puts for that January 20th expiration, for that February and March expiration. So Wall Street is expecting some volatility in 2025 as is, but I think it could be a little bit more aggressive than most people think. Again, if we have another bad jobs report, which, the trend is definitely not looking good right now following today's unemployment rate, and especially that household survey number. So let me know what you guys think about this down below in the comment section. Have a great weekend, and I will see you in the next one.